Good morning, Armor Insiders. A lot to get to this morning. A lot of things changed yesterday, and what happens here into the close will determine a lot of my portfolio positioning. We're having a explosive move in gold and silver and oil. What does that all sound like to you? Think it's tied to what's going on in Israel? I do. So let's talk about big picture. Let's talk about how we would execute by the end of the day or throughout the day, depending on what's happening. I'm going to share with you at this virtual hedge fund how I'm running my own portfolio, right? And portfolios I manage for investors. And then your job as a portfolio manager on this virtual hedge fund desk is to figure out your own strategy, use the information, be the risk manager of your own assets, and build a portfolio you're comfortable with. Okay. So let's dive right into macro picture first. And I think, the picture is worth all the words. So let's look real quick at what the market is doing right now. We have a risk on entry point. This is the strongest index, right? NASDAQ 100, big 7 stocks carrying the whole market. I discussed with you yesterday, there was a nice 4-day rally. And if it closes, breaking out of this downtrend on the high above the 50-day moving average, hey, that'll be a nice weekly bar. And, maybe we have a rally unfolding in NASDAQ 100. And it's still true. It's still true. The day ain't over yet, as Curly would say, right? And it's the week's not over yet. So NASDAQ looks the best. And then, of course, you flip over to like the equally weighted S&P and it looks the worst. Or you flip over to small caps and it looks god-awful. Or you slip over to the Dow and it looks like it's just found resistance at the 200-day moving average. So what we've got right now, and here's the equally weighted S&P. What we have right now is a market that hangs in the balance. And due to the fact, so you guys know I was long the S&P and the NASDAQ coming into the day yesterday. And we had been for 4 days. So we had a nice profit in the swing trade of the S&P and the NASDAQ weighted indexes, okay? If the risk monitor had been green, the stop on those trades would have been more lenient. The fact that those two indexes were all alone and the other 8 that we follow were still red forces me to raise my stop more aggressively to protect the gains that I've got. And what happened yesterday is that at 1 o'clock, bang, the stops were hit. We raised cash on QLD and SSO. And by the end of the day, we'd taken out our SPY swing trading only portfolio, which all it does is buy the triple S&P, hold it on average 9 trading days. It raises the stop every day to the low of 2 days ago. When it gets taken out, we go back to cash. So by the end of the day, that portfolio went back to cash and booked a 6% return in 4 days. Okay. So now it's back to cash. We started that portfolio. I started monitoring for you back last October. So we're a year into it. The portfolio is up something like 19%. There have been 8 transactions that I've outlined for you on the portfolio page, so you can go look at it and see how it works. All right, so it's up about 19% in a year, traded 8 times. Now it's back to cash and it waits for the next opportunity. We'll see what that is whenever it shows up. So what do I do from here? I mean, let's go with the bullish scenario. Market holds up here, blows out by the end of the day. It's Friday. Markets S&P is trading above this black line, which is the 50-day moving average. And I don't have any long positions on. What do? I don't care. I go to cash into the weekend. I have to now wait for the setups again from the algos. And until then, we're trading the ARMR carry trade, which is for me, the favorite place to be in this market. We're collecting 5.5% in Treasury bills every single day. And then we're opportunistically trading triple the NASDAQ, triple the S&P. And we had a good week this week, adding to our net worth on top of the interest that we're collecting. So that's where I'm focusing most of my attention. Okay. If I wasn't able to do that, if you're not on the desk and you're not able to trade like that, and you can always reach out to me if you want to discuss how I can help you do that. But if you're asking, well, what do I do for an investing portfolio that's more conservative, that I don't trade like that? Man, I'm just sitting in cash collecting yield right now. The beauty of a 5.5% yield out to March is that you don't have to worry about it. There's a lot of things going on in the world that are disturbing. The market's not behaving right. Let's get to that for a second. We've made, listen to this. This is crazy. In my portfolio, and hopefully ARMR insiders as well, we've made more money, not more. We've made the same amount of money day trading short as long in the last 5 trading sessions. Now that's called the flip trade. We did this last year during the market downtrend. Flip trades don't work in a bull market and in a real rally. The reason they work in a bear market and in a market decline is that in market declines, volatility expands. And so you'll get 2 trades a day, a rally trade and then a collapse trade. That is the paw print of a bear market. So let me show you what I'm talking about. Okay, here's the example on the S&P. This is a 3-minute chart of the S&P. Okay, and this is what we did yesterday. We were on long trades up right into here. This black dashed line is the 50-day moving average. So when it went above the 50-day moving average, right, we had long swing trades on. We tried a day trade right there. As it popped up long, I was long on a day trade right there. Okay, and when it came back below that level, when it broke back below that level, that's where we got out of whatever day trade long we had, and we booked our profit on the swing trade, and we flipped short. I went out there and bought a bunch of puts on the indexes, and you could see what happened. The market cratered. The amount of money made on those puts was like, enormous. And I share this with you because that type of money is not made in a bull market. The flip trades don't pay off like that. So that's a paw print. You have to recognize the volatility is expanded and it makes this market dangerous. And while I'm willing to put day trades on long because you can get great runs like we did this week on the day trade side, on the long side. You can get equally great runs on the downside. And so the focus on my desk is to day trade and to carry treasury bills and to protect capital. And I've been saying this for a while. And nothing changes. The risk monitor is going to be red this weekend. I don't care what the market does. Has a massive rally today. It won't make a difference. That's just crazy volatility in a very dangerous market. Okay. So why did the market have that collapse at 1 o'clock? Mark this down, in your trading journal, and remember this. It's particularly in this market. In some markets, it doesn't matter, but the Fed will auction off Treasury bonds, and the results of that, they do it periodically throughout the week, right? And the results of that auction get reported at 1 p.m. Now, in a bull market, it doesn't make a difference. Well, that news doesn't mean anything. But in this market, it means a lot. Because if the auction is terrible, if the direct and indirect bidders are a lot lower than people anticipate, what it's telling you is that rates have to go up to attract more buyers. I'm oversimplifying, but that's what it's telling you. So when the news hit the tape at 1 o'clock, by 1:06, the market was imploding because the auction went terrible. So when we see the flip trade starting and we get short, then the auction drops and the news is terrible and it's imploding, you can see the correlation. This is a very dangerous market. You get one piece of news and the bottom falls out. That's not a market where I want to be investing from the long side. I don't know when a piece of news is going to drop in the middle of the night and the rug gets pulled. Nobody's going to pull a rug on a 5.5% US Treasury bill. So that I can sleep on, and I'll day trade the swings with you, long and short. Okay. So terrible auction, as the Fed wants, right? I think the Fed wants long bond rates to be at like a 7%. They want a normal yield curve. It's inverted right now. Long bonds are a lower rate than the Treasury bill, right? So they want it to go back the other way. So I suspect bond yields are going higher. That auction kind of solidified that, and it makes it very difficult to make money in traditional stock market investments when long rates are going up like that. Okay. So now let's shift to now let's shift to what's going on this morning. There are some major moves going on in gold and oil, and doesn't that play into the negative picture of the market? Okay, so take a look right here at let's take a look at gold. Let's close the door on the dogs. Okay, let's take a look at gold. I got no interest in that chart. That looks terrible. I don't want to own gold. Okay. Gold is trading right here now at 177 and change. That's right around here. 177 and change. So this morning, GLD is above the 50 and 200-day moving averages. And if this rally holds all day and gains steam, I will be long gold in the portfolio. Okay. PHYS will be the position I'll hold, which, by the way, right now, spot physical is 1480. So gapping above, so going from below the key moving averages to above the 50 and 200 day, I'll have my whole position on by the end of the day today. And a low of today would be the stop, or the 250 will probably be the stop. So if it can hold the gains, I don't generally buy gold and silver and oil on gap ups in the morning. But if they hold, I'm even considering owning calls on USO. I'm not going to buy USO. It's a limited partnership. You get a ridiculous K1 at the end of the year and all that stuff. But I might have a out of the money call option that goes out to December on oil. Almost like a lottery ticket. If things, obviously, when oil, gold, and silver by definition, definition that goes with gold, when those things are up big, that is clearly, as Erez writes in the Slack room, a fear trade. So we get out of the long side, market rallies, breaks down. I own puts overnight, so I'm short overnight now. So I have a short position overnight. And we're seeing the assets that go up a lot based on, if we just think of it logically, the reason gold, silver, and oil would go up a lot today is fears of an escalation that's going on in Israel. But that's just what it is. Let's call it what it is. So when the news last weekend, when the horrors of last weekend unfolded and we came in on Monday, I said to you, I'm not buying oil on this news. I'm not buying gold on this news. I don't like the knee-jerk reaction. But I want to watch it. I said this to you Monday. I want to watch these assets, see how they trade. And depending on the weekly close, I may own them. So if this gap up of 2+% on gold, 3% on silver, and 4% on oil holds all day, then what you're going to see me own in the portfolio is spot physical gold. This chart I have no interest in, but a gap up here I do have an interest in, with a stop obviously below the 50 and 200. That's a no-brainer. Okay, silver, spot physical silver is at 768. 768. So we'll see how silver does. I have more of an interest in gold, but obviously if gold goes, silver will follow. So I may be on silver. We'll have to see where it closes, guys. Okay. USO is trading at 77.73 now. 77.73. So somewhere around here. It's come down to the 50-day and it's gapping up. So if this turns out to be, whoops, that's not what I wanted. If this turns out to be an island reversal, so it's a gap down to the 50 and now gap out and go in here, I'm going to want to own perhaps calls on oil. I don't know. I might. $90 calls. I don't know. Something out of the money to December that if things get out of hand turns into a lottery ticket. Okay. I'm XLE and XOP. I'm going to go obviously with the ETFs. I don't want individual stock risk. XOP and XLE look great. I'm not sure I'm going to go with OIH. I think I want the producers, XOP and XLE. And I think I probably can add to my AMLP position, which I wish I'd done on that 3-bar selling. That would have been beautiful. I've been adding all the way through here. So periodically I add to my pipelines. That seems like a no-brainer to me in here. And if I wanted an OIH type of position, I probably would rather just buy Tidewater and FTI and a couple of our favorite names. If I want to do that, I'm not sure I want I wonder if I want the refiners. God, the refiners have been smacked. No, I think I'm going to just go with XOP and XLE, and I'll have a position size on that's large enough for me to benefit for the portfolio to make some money if energy takes off. So that's got to be the highlighted group today. Gold, silver, XOP and XLE, where I'll put all the capital that I want exposed to oil, and maybe some call options on oil itself going out to December. Would I own mining stocks? I don't want to own mining stocks. I don't want to own mining stocks right here. Although, they're going to gap up 4%. So I'll consider it. Nugget is the way I would do that. I don't even know if I need double anything in this market. Maybe just GDX outright and be done with it. Probably I'm going to do that. This market is not a market if I'm going to get long where I want double or triple anything other than the indexes. I'll trade SSO and QLD, but I would go GDX, Sprott physical gold, Sprott physical silver, and then I would go calls on USO and XOP and XLE. And I might have that position by the end of the day. And we'd all have to decide what our, something in my eye there, what our position sizes are. I don't, how much risk do you want to take in a portfolio? It doesn't have to be huge, but we might want to commit some dollars to that. I could see maybe 25% of a portfolio that I'm managing, maybe 25% dedicated to the commodity space. That's it. 25% I dedicate to the commodity space. This is how my portfolios look right now that I trade for investors. I've got about 50% sits in money market funds that I use for investments. 50% sits in treasury bills, and I trade that in the S&P and the NASDAQ during the day. So of that 50% that's in money markets, 25% would be for swing trades on the indexes, SSO, QLD. Okay. And 25% is all I'm willing to commit to investment ideas that I think in a market like this. So I might take GDX, Sprott physical, XLE, XOP, and divide it into those 5 investments, put the capital to work. So we'll see if that happens by the end of the day. Okay. Those are my thoughts for you. And I'm just going to leave you with this one. I want you to be the judge of this. Okay. I want you to be the judge. I don't want to, I thoroughly admit this is a little bit of is it fear mongering? I don't know. Take a look at this chart though. I don't usually talk about this stuff, but I figure what the heck. Take a look at that chart real quick. Okay. And what you're seeing on that chart is this. The last time U.S. stocks were this pricey relative to the debt market, the S&P 500 dropped 50%. Is that fear-mongering? Maybe. I always say to you, you can find any statistic you want to fit your narrative. So I thoroughly admit that this is a statistic that fits the narrative. Okay. The narrative being, I think this is a dangerous market. But there's where we were back in, what is that, 2000. Okay. And here's where we are today. So we already know that the valuations on the market are ridiculously stretched. And I don't care about that statistic. I don't care about valuation statistics. If the risk monitor is green and the algos are telling me to get long, I'll put money to work. I don't care about that statistic. But if the market begins to behave in a very erratic and dangerous way, and you look at that statistic, it dovetails with what happened yesterday at the auction. We're already at an obscene level when it comes to debt versus equity. And then that auction was terrible and the market plummeted. So that's why I share that chart with you, because it dovetails with what's happening in the debt market. It's why the market's so sensitive to what's happening with TLT, long-term bonds. We're already at ridiculous levels of equity versus debt. And so if you're thinking to yourself, what the difference? Why did the market crater at one? That doesn't make any sense, but it does make sense. If you see how sensitive we are, we're already at a point that doesn't make any sense when it comes to debt versus equity versus debt. And then you get an auction where nobody wanted the paper. Market's very dangerous. Be careful. Be the smart money. I'll see you guys on the live desk at 9:30 and we'll get at it together. Have a great trading session, everybody.